If you're like me, it is a spooky time to be investing right now. And for the past couple of months, with all the YouTube finance thumbnails and other things telling me that everything is going to crash and everything's falling apart and the world is basically going to end for finances, you may have been giving more consideration to stocks that issue dividends, and more specifically for people that are afraid of risk with individual stocks. They've been looking at ETFs and other things that happen to have high dividend yields, or yields that are not necessarily entirely correlated with the market index. So that way they can hedge against the risk of drops in the index or a recession or other things. Well, for me, I've been doing research on stocks and ETFs for a very long time, and I've been particularly attracted to things that issue dividends because I drank the Kool-Aid on the whole dividend growth investing arguments and the whole thing with compound interest and dripping the dividends and how that leads to alpha over the stock indexes and other things in the long term and yada, yada, yada. Basically, I've been looking at stocks and ETFs for their yields, their general performance, whether it's correlated with indexes and other things. And I've done deep dives into a number of things that have fairly high yields, but I'm not really interested in the yield as much because the possibility of there being a yield trap. I'm more interested in the fundamentals of things and also the overall total return of the stock when you are accounting dividends and the stock price movements versus just say dividend yield alone. Almost everyone that has started doing research into dividend stocks understands what a yield trap is. But as 2023 went on and the markets were doing okay, and some people were looking at options for getting a little bit of extra income or a little bit of alpha or whatever it was, there was a company that began to release a series of ETFs called Yieldmax funds. What Yieldmax funds are is they take a blue chip growth stock like Coinbase or Tesla, and they start trading options on it, and they return the premium and income gained from those options trades to ETF shareholders in the form of dividends. Now, the problem is that each of these Yieldmax funds are all based on derivatives trading on one individual stock. And that's where I have a big problem. You are introducing a whole load of risk into things, into your investments by investing in these funds. But with that being said, some people were like, oh, well, I heard that they have a high dividend yield, and they started doing a little bit more research. And they went long depends because they started looking at TSLY and saw a few months ago that it had a 69% dividend yield. They were crapping their pants left and right at how insane of a yield that was. And then they started going down rabbit holes of looking at alternative things like, oh, there's NVDY and the ARK Yieldmax fund and the Coinbase Yieldmax fund, and then there's also KLIP and other alternative assets that are basing all of their returns on the value of derivatives on individual stocks, or maybe a basket of thinly traded or just weird stocks and other things like that. And that introduces a boatload of risk investing in an ETF that only has one holding. Now, TSLY seems to be the most popular one because it had the highest yield. Now, unfortunately, I'm making this video a couple days late because Tesla just announced earnings and Tesla's share price is about to go down, and consequently TSLY's price is probably going to continue to go down. And in addition to that, in the month of September, I don't believe that they were on record of issuing a dividend in September. And then when they came out in October, before earnings, they had a dividend that was a lot smaller than any of the previous dividends that they had issued through the year. Now remember, this fund has only been in existence for 2023. So it doesn't have a lot of historical price and return data and other things out there that would allow you to make a more well-rounded and informed decision or have a general feeling about how to trade the stock. But when things are going good, everyone is a genius in a bull market. And when Tesla stock was going up through this year, Tesla was able to make the money necessary to pay the insane dividend income. But now that Tesla stock price is going down, it's highly possible that they're going to start cutting their dividends because they aren't making any money off of the options contracts that they had on Tesla stock. Now, if things were going right, I think that the only possible way to trade Yieldmax funds is that if there is a bull market and it is getting the insane return that it is getting, the only real way to trade a Yieldmax fund is to buy in increments of 100 shares, buy a at-the-money put option with maybe a year to expiration for each of the block 100 shares that you have, and then just wait and collect the dividends. What you would be doing is something called a synthetic call, and what that means is that you don't have any capped upside potential on the stock price. You get the dividends, but you have capped your downside with buying the stock. Because of the massive amount of risk, I don't see any way to be buying Yieldmax funds without buying put options on to basically hedge your bets on whether or not you're going to lose everything. That way you can at least save your principal. The maximum amount of money that you'll have to pay out of pocket is just the options premium. And given the fact that the funds are fairly cheap in valuation, you're not going to be like out of pocket like thousands of dollars on buying puts on the stock. But it allows you to capture potential upside in the event that the value of the fund actually goes up, which, given their track records, I don't really see that happening now, and it's been in a downward trend. But what it would enable you to do is cap your downside, capture the dividend, and the difference between the put option premium and the dividend should give you, like in Tesla's case, if it continued to go ahead and issue a 69% dividend yield, the put option premium is going to be kind of closer to roughly about 30 to 40%, I'd say, roughly. I'm not looking at the numbers. I looked this up earlier, and I'm just going off of memory right now, but it'd be close to about 30 to 40% of that. And so really you'd be walking away with maybe 15 to 30% gain from that with capped downside. So you're eliminating the risk of losing your principal investment, but you're able to capture the dividend. But there's no way to trade Yieldmax funds without buying puts. That's just my opinion. Thank you for listening today, and have a good day.